Good afternoon. My name is Dr. Mike Sykuta. I'm the Executive Director of the Financial Research Institute at the University of Missouri, and we welcome you to this issue or episode of our Hot Topic Hotline, focusing on monetary policy, inflation, and interest rates. We did this last year. We thought it was time to do an update, given where the economy is going. We have with us today a really interesting and exciting panel, I think, to share their thoughts and perspectives on this. Dr. Carly Dilts-Stedman is a senior economist in the Macroeconomics and Monetary Policy Division at the Federal Reserve Bank in Kansas City. Dr. Stedman joined the bank in 2019 after earning her PhD in economics from the University of North Carolina at Chapel Hill. She holds an MA in International Relations and International Economics from Johns Hopkins University School of Advanced International Studies, which is a mouthful, and a bachelor's in economics from New College, Florida. Her research focuses on international dimensions of monetary policy and monetary policy transmission at the zero lower bound of interest rates. She's published articles on monetary policy, capital market flows, and global financial markets in peer-reviewed journals such as the Journal of International Economics and Review of Financial Studies, as well as working papers and research papers published with the National Bureau of Economic Research and the Kansas City Federal Reserve Bank publications. We also have with us Commissioner Kim Drexler. She was appointed to the Delaware Public Service Commission by Governor Jack Markell in May of 2015 and was reappointed by Governor John Carney in May of 2021. Kim is a graduate of Brown University. She started her career in finance in the energy division of manufacturers Hanover Trust Company in New York, and was a vice president and senior private banker with Wilmington Trust Company. She's serves as treasurer of the Mid-Atlantic Conference of Regulatory Utility Commissioners, or MACRA, and is a member of the National Association of Regulated Utility Commissioners, and a board of directors of the Organization of PJM States. In a past, Steve Kime is a regulatory strategist specializing in economics and finance with the Wisconsin Citizens Utility Board, or CUB. He joined CUB with 4 decades of experience in analyzing economic and finance issues in utility regulation, including 21 years as a member of the Wisconsin Public Service Commission staff. He's also held positions at for-profit consulting and nonprofit research organizations. He's testified as an expert witness across the country and has published articles in the Journal of Applied Corporate Finance and the Energy Law Journal. He holds 2 master's degrees in business from UW-Madison and a doctoral degree in business from UW-Whitewater, University of Wisconsin-Whitewater. And finally, we have Darren Ives, is a VP of Regulatory Affairs with Evergy. He oversees the strategic development and administration of pricing, rates, rules, regulations, revenue requirements, tariff filings, and customer contracts at the federal, Kansas, and Missouri levels. He joined KCP&L prior to its acquisition or merger in 1986 as an accountant. He assumed progressive levels of responsibility in the accounting service division, serving as assistant controller at the time of his move to regulatory reporting, or to regulatory affairs. As assistant controller, he was responsible for the external financial reporting, regulatory reporting, and accounting research. Darren is a CPA and worked previously at Coopers-Lybrand. He holds a Bachelor of Science in Business Administration from Kansas State and a Master's of Business Administration from the University of Missouri, Kansas City. So welcome to our panelists, welcome to our guests. Our program today, we're going to start with Dr. Stedman. She's going to provide her perspective on where we are with the macroeconomy, monetary policy, inflation, what that means for possible interest rate moves down the road. And once she's shared a short presentation, each of our other panelists will share their kind of reactions and thoughts on what that means for our regulated utility space. We'll have some time for Q&A at the end for members from the audience. I encourage you to click the Q&A button at the bottom of your screen, at which point you can type in your questions and we will come back and get to those questions. So with no further ado, Dr. Stedman, I will turn the floor and the screen over to you.
Great. All right, is everyone able to see? Perfect. All right, well, greetings everyone, and thanks to Mike for inviting me to review the national outlook with you all today. My name is Carly Dilt-Stedman, and I'm a senior economist at the Kansas City Fed. So as such, I'll start by issuing the disclaimer that the opinions in my remarks are mine alone, and not those of the Federal Reserve Bank of Kansas City or of the Federal Reserve System. So the title of my remarks today is Waiting to Exhale, classic film, as we hold our collective breaths looking for signs that monetary policy is taking a firm hold on inflation, hopefully without provoking a recession. Now, the FOMC has raised the policy interest rate more than 500 basis points in the last year and a half. However, as Chair Jerome Powell remarked on June 28th, although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough. This is because the current bout of inflation that we're experiencing has proven pretty sticky, and the more interest rate sensitive areas of the economy that have since brought us closer to the Fed's target since last summer may not have enough left to deliver disinflation that will bring us back to 2%. In short, the low-hanging fruit appears to have been picked, and now maybe the hard work begins. So we're finding ourselves in the world of what's being called higher for longer. Although in June, markets had been anticipating kind of aggressive cuts to the policy rate by the end of 2023, the message that policy rates may remain near their current levels for a longer period appears to be penetrating. To give a personal anecdote, my spouse and I recently opened a CD with our bank. When I first started talking to him about it on July 14, my husband, who is not an economist, sent me the screenshot on his phone on the left and asked me, basically, is this the inverted yield curve you're always talking about? And you can see that on July 14, the highest available return on CDs is at the 15-month maturity, right here at the bottom. After that maturity, 18 months, 2 years, and so on, the return pretty rapidly comes down to around 2% on the 4-year CD and stays there for the remaining horizon available. This is the result of financial markets anticipating that the Fed will start to lower interest rates pretty markedly by the end of the year. So I checked the same page again after the FOMC's most recent meeting, at which they again raised the interest rate 25 basis points. And this is the screenshot on the right. While the market is still pricing in cuts between months 15 and 18, the rate 2 years ahead is almost a full percentage point above what it had been 2 weeks previous. And the rate 5 years ahead is almost 2 percentage points above that which prevailed 2 weeks ago. So importantly for my remarks today, the rate is higher than it had been at most horizons and is holding steady for that at that point for several years until the very longest horizon. The rest of my talk contemplates this higher for longer setting, and I'll proceed as follows. So first, why might we believe that interest rates have to remain higher than previously anticipated for longer than previously anticipated? Essentially, the progress that we've made on inflation so far has been concentrated in core goods and energy, leaving services inflation still above target. And services inflation, as we'll see in a little bit, is heavily affected by labor markets, which continue to just thrum on. While the current tightening cycle has involved some jumbo-sized rate hikes, financial conditions don't yet appear to be restrictive enough for long enough, as Chair Powell said last month. Next, I'll highlight some reasons to be optimistic that higher for longer can still be consistent with the coveted so-called soft landing. And in particular, on aggregate, households and firms appear to be reasonably well positioned to weather the high tide of interest costs without setting off what we might call recessionary dynamics. But then to conclude, I'll highlight some of the risks to this outlook. So in particular, there are segments of the market that appear vulnerable to a higher for longer outlook, and the realization of risks to those segments do have the potential to spill over to the broader economy. All right, so why do interest rates likely need to stay higher for longer? The obvious answer is that inflation remains intolerably high on an annual basis, but I want to take a couple minutes to dig in on that. So this slide features a graph of 3-month annualized inflation in core goods and core services, which strips out volatile food and energy. The earliest form of inflation that we observed in the current episode was in core goods, which is shown in green. And this is widely believed to have been at least set off or sparked by supply chain disruptions put in place by the pandemic. However, eventually inflation rotated from goods to services, which are shown in blue, and increasingly reflected a disconnect between robust demand and anemic supply. Core goods had been trending in the right direction, although the most recent data here at the very end of the time series shows an unwelcome increase. Services inflation, on the other hand, has remained stubbornly above overall target for many months, including after a dip in the most recent readings. So let's dig a little bit deeper to think about why monetary policy has work left to do to bring inflation back down to target, and why the sources of disinflation that we've seen so far may not be particularly helpful on that front. So this chart shows headline CPI inflation on a quarterly basis, annualized and broken down into core and non-core components starting in 2020. On a 12-month basis, inflation in gray has fallen from its peak of 9.1% in June of 2022 to 3% in June of 2023. And while the 12-month inflation figure remains above the Fed's target, prices are rising more slowly than they were last summer, and recent readings on a month-on-month basis are consistent with the committee's target when they're annualized. This is obviously a welcome development, but we'll need to see more inflation prints like that before the overall 12-month inflation figure reaches 2% on a sustained basis. As I noted on the previous slide, early inflation throughout 2021 received substantial impetus from core goods, pictured here in orange. However, in the headline breakdown, we also see a big contribution from energy goods inflation in purple. Starting in about mid-2022, core goods inflation began to subside. And at the same time, progress on fighting inflation received a notable boost from falling energy prices. So we can see that what goes from a big positive contribution in purple before mid-2022 goes to a disinflationary pressure, particularly from gasoline. So the natural question is whether patterns like these can deliver us to the 2% target. Unfortunately, energy doesn't really appear poised to deliver much additional disinflation going forward. Starting with the chart on the far left, the line plotting the WTI spot price shows that this summer, the price of oil halted a plunge that it had begun in mid-2022 and has started again to climb. In green, I've plotted the expected trajectory of the oil price over the next 2 years using WTI futures contracts. And while oil is not predicted to rise in price over the next 2 years, neither is it expected to fall appreciably. To see why, we'll move on to the center chart. And according to the International Energy Agency, or IEA, global oil demand hit a new record high in April and on average is set to outpace supply in the next few years. This middle chart shows oil demand in blue and supply in green, along with the organization's estimated global demand and supply over 2023 and 2024, which are shown in dots. So the forecast are dotted lines and the solid lines are data. On average, over the next 2 years, demand is expected to outpace supply, which will pop up energy prices. In the IEA's estimates, the main growth in oil supply is set to come primarily from the United States, as output from the OPEC Plus producer group will decline by more than 870,000 barrels per day. Supply in the United States, however, doesn't really appear to be gearing up too much to meet that demand. The right chart shows the annual growth in rig counts in the United States in blue, along with that of real private investment in mining, exploration, shafts, and wells in green. Both of these have fallen considerably since around mid-2021. On top of domestic developments like these, Russian and Saudi promises to cut production may also dent supply in the short to medium run. Given the forces feeding oil demand and suggesting diminished supply growth, conditions don't really appear poised to deliver the same disinflationary impetus that we saw in those salutary inflation readings. And if goods and energy aren't set to deliver much more, that means that core services inflation will have to come down to realize further declines in inflation. Returning to the inflation breakdown that I showed you on the previous slide, we see that as energy and core goods waned in their influence over the headline number over the last couple of months, shelter inflation in blue and services ex shelter in green have surged to the forefront. Housing inflation in particular comes in by itself above the Fed's target. So I'll turn next to developments on that front. Throughout 2022 and for much of 2023, we saw reasonably clear evidence of the effects of monetary policy in interest rate sensitive sectors of the economy, which seem to have spread into expectations of future demand. Rising interest rates appeared to have cooled the housing market considerably, which would eventually pass through to services, shelter services inflation. The left chart here in blue plots existing home sales, which plummeted from late 2021 until this summer. And then on the right, I've plotted various home value indices from the FHFA, Zillow, and from Case-Shiller. As fewer homes changed hands over the course of 2022 and early 2023, demand for goods like appliances, furniture, and inputs to home improvement fell along with home values, albeit somewhat modestly. However, we're already starting to see a reversal on this front. So recent readings in housing suggest that the housing market may have reached a nadir for now, with existing single-family home sales ticking back up in recent readings and with it home prices. So the hopes that aggregate developments in the housing front will help to deliver that disinflationary pressure are looking a little bit questionable, and this is pretty troubling. This is occurring in part because labor markets remain historically tight, and this fuels services inflation. I'll get back to the link between labor markets and service inflation in a moment, but I'd like to start with a summary measure of labor market tightness that the Federal Reserve System has been using to think about the disconnect between the degree to which the demand for labor outstrips supply. So this is vacancies per unemployed individual. And currently on the left in blue, you can see that we're about 1.7 jobs for each unemployed individual in the United States. So basically, while we would think of inflation as too many dollars facing too few goods, this situation is too many jobs chasing too few workers. So while the so-called V over U has ticked down over the last few months from a high of 2 jobs per unemployed worker, it's still pretty elevated, well above its historical average of around 1. Coinciding with the tight labor market is near unprecedented wage growth. The chart on the right shows the Atlanta Fed wage tracker for 7 different industries, along with a dotted line indicating the long-run aggregate average. So the FRB Atlanta wage tracker shows annual growth in a number of industries along with the aggregate. So while the last couple of months, you can see at the end of the time series have indeed dented wage growth compared to the historical run-up over 2022, all industries remain above their historical averages. I plotted leisure and hospitality in red to highlight it as a particular source of inflationary pressure, because these services are uncommonly labor intensive, and among services inflation categories represent a particularly hot category. As I noted in a previous slide, future progress on inflation probably has to emanate from services, and tight labor markets, as I'll explain here in just a second, have a disproportionate impact on this category of consumption. So I'll start with this chart on the left, which pictures the impact on annual CPI inflation from an increase in vacancies to unemployment, that labor tightness measure I showed you a moment ago. Recent work from my colleagues Brent Bundick, Lee Smith, and Luca Vandermeer shows that labor market tightness has the smallest put through to core goods inflation, has the smallest impact on core goods inflation, probably because the goods producing sector is less labor intensive and more capital intensive than many services, i.e. more interest rate sensitive. Consistent with this explanation, the pass-through to non-housing core services inflation, which is a category that includes labor-intensive industries like labor and hospitality, plus education and healthcare, is twice as large as that which goes through to goods inflation. However, the pass-through from labor market tightness to housing inflation is estimated to be just as large as the pass-through to these labor-intensive industries. And this might strike us as strange because housing and building housing involves sensitivity to interest rates. However, one explanation for the observed influence of labor market conditions, in particular on rent inflation, is thinking about demand as being a faster acting impetus rather than supply. And this is because changes to rental supply tend to materialize very slowly. According to the US Census Bureau, it takes about 18 months to build an apartment complex after a permit has been acquired, and obtaining the permit takes longer than that. So we have in place a system in which changes in demand for shelter, which are elevated by wages, largely shape rent inflation over shorter economic cycles. So taking this labor tightness or view over U framework back to inflation more broadly, recent work from Ben Bernanke and Olivier Blanchard from the IMF suggests that in order for the Fed to achieve its target inflation of 2% by 2025, vacancies to unemployment would have to fall by more than half. So this chart on the right maps out this conclusion, showing from that paper how inflation would evolve under different values of vacancies to unemployment. So if labor markets stay as tight as they are, that is around 1.7 to 1.8, inflation will remain above 3.5% by these authors' estimates past 2027. This is shown here in the blue line. In green, we see that even if it's brought down to a more typical 1.2, it will still lay above the Fed's target at the end of 2026. The only value in the paper consistent with reaching the target by 2025 is a V over U of around 0.8. These stylized facts suggest that monetary policy has to stay restrictive. Interest rates have been rising, though, for the past 16 months, and that feels like a long time. But for the Fed to begin cutting rates in the near future, as markets had been anticipating, would not only run counter to all of the indicators suggesting more contractionary policy is needed, but would also make this hiking cycle short compared to others. Historically speaking, the average interest rate hiking cycle has lasted more than 21 months. This chart, to which shows the Fed funds rate in red, with shading in gray, indicating tightening cycles that lasted longer than the current one. With many signs suggesting that the forces behind inflation have not settled, to envision cuts in the near term would seem short-sighted. On top of that, financial conditions are actually loose right now compared to their long-run averages, and have gotten looser over the course of this year. To make this argument, I'm showing here a chart of the Federal Reserve Bank of Chicago's Financial Conditions Index in red, with its axis on the left, and the Goldman Sachs Financial Conditions Index for comparison in gray, with its axis on the right. In each case, for each of these indices, readings above the x-axis correspond to financial conditions being tighter than the historical average, and readings below the x-axis correspond to conditions that are looser than the average. As we can see in this chart, despite months of tightening policy, financial conditions affecting consumers and firms' ability to finance consumption and investment are not restrictive in historical perspective and are less restrictive than they were a year ago. Despite the outlook for interest rates remaining elevated is present, there is reason for cautious optimism. In particular, conditions associated with the onset of recessionary dynamics are not in particularly heavy evidence. So here I've plotted 3 indicators in support of plugging along. First, on the left is after-tax profits and cash flows with EVA of non-financial corporations. These are both expressed as a percent of GDP to neutralize the measurement impact of inflation. While profits as a share of GDP have fallen over the last 2 quarters, they remain remarkably high. And both cash flows and profits remain above pre-pandemic levels. And these 2 objects are among the best predictors of capital expenditures. Another strong predictor of CapEx is the Gilchrist and Zakrajsek excess bond premium estimated by our colleagues at the board and pictured in the graph at the center. The excess bond premium offers a measure of credit spreads that is net of predicted default losses. And this excess bond premium strongly predicts credit investors' risk appetite and thus a borrower's ability to invest. And we see that in this time series, that risk aversion measured in this way is pretty subdued and is certainly lower than that which we've observed during recent recessions. And finally, consumer sentiment, which I'm showing here as measured by the University of Michigan surveys, has rebounded since last summer. Overall, measures of consumer sentiment do suggest that consumers are feeling the squeeze of higher rates, but that they appear to be basically hanging in there, so to speak. Many firms are reasonably well placed to manage increased interest costs. So As I mentioned a moment ago, by and large, firms have cash on hand to finance inventory and CapEx. The chart on the top left shows the total shows cash to total assets of corporate firms in gray and of non-corporate firms in red. And the dotted lines indicate long-run averages for comparison. So to be clear, I'm showing both incorporation types in order to highlight that cash on hand is not limited to firms with freer access to financial markets. Firms that are not non-corporate might ordinarily have to rely more on bank lending or other financial intermediaries, and these firms also have a cash buffer. Zooming in on smaller firms, the National Federation of Independent Firms, or NFIB, collects survey data on business conditions on a monthly basis, which we can use to give us a glimpse not only into funding conditions, but also of the challenges that firms faced more broadly. In the top right chart, I'm expressing the NFIB survey response as a percent of firms responding in the affirmative, less those responding in the negative. So this is a diffusion index of yes, less, no. We see in red that the percent of firms responding that their borrowing needs were in fact satisfied in the last 3 months has actually ticked up in the most recent readings, indicating that firms seeking credit were able to access it at a rate that's broadly consistent with pre-pandemic trends. Similarly, the gray line shows that while the percent of firms suggesting that credit was harder to get the last time they tried did edge up in recent readings, the change is modest relative to recent history. So in sum, survey respondents are not signaling outsized difficulty financing their plans. What they are having a hard time with is inflation. The bottom chart shows the proportion of NFIB respondents for whom a particular issue was most important. Usually the availability of quality labor, shown in blue, ranks number one across firms as their most pressing issue. In yellow is financial and interest rates. So while we can see that it is modestly higher or fatter, I guess, than it has been in the recent past, it's still ranked dead last among potential responses in the July survey. In red, we see that inflation has surged to the top of the pack, underscoring the importance of getting price growth under control. Still, there are some segments of the market that are less well prepared to weather higher for longer, and it's important to give shrift to these risks. In particular, vulnerable firms have the potential to generate spillovers to other parts of the economy by direct effects on employment and output, but also by buffeting the balance sheets of financial institutions. Higher borrowing costs can result in weaker corporate fundamentals and higher default risk if these firms prove unable to pay or refinance when their loans reach maturity. Following the onset of the most recent hiking cycle in 2022, borrowing costs on newly issued bonds and loans have indeed increased by several percentage points. When the record levels of bond issuance that was taken out during the worst of the COVID-19 pandemic begins to mature, these firms will have to be refinanced at a significantly higher cost. Companies not only got cheaper rates at this time, but refinanced some of their debt in order to push their maturity profiles to the future when they refinanced in 2020 and 21. So the figure on the left of this slide punctuates that maturity wall. If interest rates stay elevated through 2026, that will impact more than 40% of investment grade firms' debts in gray and around 30% of maturing debts for high yield and leveraged loan borrowers in olive and burgundy. Investment grade firms are sort of the best placed to weather those types of, to weather this maturity wall, whereas high yield and leveraged loan borrowers are more vulnerable. I've split the weakest category of firms, which are leveraged loan borrowers, into 3 splits of increasing risk in the chart on the right. Again, this is the cumulative amount that will have come due in a particular year or by a particular year. So we can think of this as like the arrival rate of the maturity wall. So I've split the weakest category of firms, which are leveraged loan borrowers, into the 3 splits of increasing risk. The lowest tier firms in dark red will see 45% of their debt mature by 2026, which is sort of well within this lower for longer horizon that we're observing. And weaker firms like these may not have the levers to pay down their debt with free operating cash flow, meaning that those interest costs will be realized and these firms could end up in default as a result. While, as I highlighted before, financial conditions overall are not particularly tight, we do see a retreat in bank lending. The chart on the left shows that monthly growth in lending to businesses, so commercial real estate and C&I lending, as a 3-month moving average, has been slowly falling over the last year, and growth has stagnated in recent weeks. On the right, I've plotted responses from the Federal Reserve Board's Senior Loan Officer Survey regarding credit demand and credit standards. In solid lines are responses pertaining to large and medium firms, and in dashed lines are those corresponding to lending to small firms. And I make this distinction again to highlight the degree to which it doesn't matter the category of firm in terms of their ability to accumulate and hold on to cash. This is both small firms and large firms alike. Over the last year, we've seen both the supply of and demand for bank credit wane. Banks are reporting that both small and large firms show less demand for C&I loans from banks as well, while these same banks have also recorded that their credit standards have tightened. So this slowdown in bank lending poses an acute threat to structures investment because commercial real estate is particularly exposed to bank lending, as are small firms. So to conclude, we're in a higher for longer world, and that's because inflation remains stubbornly high. The progress that we have made to date stem from advancements in energy and interest rate sensitive sectors, which may not be poised to deliver additional disinflation. And as such, services inflation will need to be abated, and that will require cooling labor markets. There is some cause for cautious optimism in the sense that consumers and firms have proven remarkably resilient. And this is in part owed to the dry powder that firms and individuals built up across 2020 and 2021, which could help facilitate a so-called soft landing. And then finally, there is also some cause for caution as we think about the risks to this outlook. A higher for longer world will disproportionately affect some segments of the market. And in particular, commercial real estate, leveraged borrowers, and bank-reliant firms stand vulnerable. And this carries potential spillovers to the rest of the economy as those firms are forced to lay off workers and pull back on their investment, but also as their failures buffet financial firms. So those conclude my prepared remarks for today. I look forward to hearing from the other panelists.
Thank you very much, Dr. Stedman. A lot of detail and background about what's going on there. Commissioner Drexler, let's start with you in terms of your take on what Dr. Stedman has shared and where you see this moving and what it means from your role as a commissioner.
Well, thank you. Specifically, when we're talking about utilities, all of these factors seem to be kind of negative, starting with inflation. For our, we're reviewing utilities, we're looking at rate increases, we're looking at the structure and the health of the utility companies. Inflation is obviously going to create higher costs of service for the utilities. That includes commodity costs, labor costs, and any other costs regarding cost of service. So number one, its costs are going up. The company has to look to either raise, equity markets or, debt. And as Dr. Stedman mentioned, debt is becoming tighter and more expensive. And when the cost of capital goes up and you're looking at a utility, you're going to compare that utility's ratios, debt to equity, with other utilities to sort of determine what the financial health of that company is in terms of its debt and equity structure. As a regulator, you're going to compare it to others in your state and in other nearby states. How is it doing compared to those? Is it a weaker company? Is it a stronger company? It goes without saying that utility companies are highly leveraged. They carry a lot of debt. In the short term, as Dr. Stedman said, interest rates aren't going to affect the company's long-term debt, except that, as she mentioned, all of these maturities are coming in 24, 25, 26. So you may have a well-positioned company with a lot of good long-term debt that's not so long-term. In order to refinance, that's going to be a lot more expensive. The banks are tightening, and end up in a situation where your debt to equity ratio becomes a lot less attractive. And when you're seeking to, when you're seeking to increase rate base or coming back for rate increases, it's going to be tough because if those costs are rising higher than what regulators are willing to approve in terms of, rate increases, you're in a situation where the investors are going to take a hit, and investors are, easily swayed to other investments, especially your more conservative income-seeking investors who are looking for dividend income, specifically from utilities. And in a low rate, almost zero rate environment that we've enjoyed since 2008 up until recently with the 500 basis point Fed rate increase, it's been a pretty good place to invest with utilities, because as the rates were so low, bonds were expensive, returns were a lot smaller, and in the past year, there's a flight to bonds, of course, because as bond prices decrease, the yields are higher, and investors, especially those conservative income-seeking investors, are potentially going to be leaving investments in utility companies, even with its, approximately 4.8% dividends. So that's a problem too for companies. And again, the huge investment in capital for renewables that utilities are faced with in the future are going to be extraordinary, and the capital for those are going to be extraordinary. So it's not just a case of grid reliability and maintaining resiliency and reliability. It's grid modernization that's going to bring a situation where utility companies are going to have to invest significantly. And the good news is that the Infrastructure Act of 2022 can bring those costs significantly down for companies that are investing in renewables, because those costs have also skyrocketed. So as as regulators, we're looking at these investments, and we're in conjunction with our utility companies, we're hoping that this Infrastructure Act significantly reduces those costs to the utility and therefore to the consumer. So as long as they are taking advantage of of these opportunities and these of the Infrastructure Act, that's going to be the big positive here, because as interest rates go up, you're going to have a situation where debt's costing more. Your flight to bonds are really going to affect those debt to equity ratios that we look for when we look at companies. But anything good like an offset is something to look forward to. So, fingers crossed that as companies come in and ask for, rate increases, we understand all of the parameters and understand what is happening, not just to that company, but companies like it, and what's happening in the market, and how the companies are adjusting to those. What are the steps they're taking to adjust to those, to minimize just an overall negative situation where a regulator is going to say, hey, we're not interested in, and we're not willing to, grant everything. And then it's on the investor and it's on the company. It's on, higher debt. So those are the things we're looking at. And those are the things that inflation and interest rate increases are causing our utilities some amount of stress, I guess. Thank you.
So I'm going to go to Darren next, and Steve, you kind of get a rebuttal from the customer side. And Darren, since we arranged this program, a report came out from the Kansas Corporation Commission that Evergy's 5-year capital expenditure plan is up to $7.6 billion. So obviously there's a lot of capital investment to be made. Commissioner Drexler talked about the need to finance that stuff. So this is really timely given the information that just came out about Evergy's capital investment plans too. So, where are you seeing this, and what do you think how do you see it playing out?
Yeah, so thanks, Michael. Can you guys hear me okay? Yeah. So one of the things that we talk about a lot at Evergy, as do many of our peers, is it's incumbent upon us to balance customer affordability, reliability of our system, and sustainability of our system as a franchise provider of energy in our service territories. You mentioned the numbers, and they're not insignificant by any stretch, and we'll talk about a couple of reasons why. But I think the point, and Commissioner Drexler hit it well. Interest rate and inflationary pressures, put substantial pressure on the balance that I just spoke about. Two real implications to the utilities of these conditions. One, and Commissioner Drexler hit it well. It's our cost of capital, right? Our debt financing, the amount of equity returns that our shareholders are looking for in a higher priced market environment in order for us to remain competitive and get the funds necessary to make the investments that you talked about, Michael. Um, the returns are rising on both sides of the equation on that cost of capital and making it difficult and an additional burden on top of kind of the core infrastructure investment we're talking about. And the second one, it's related, right? It's we have our own cost of capital, but we're also impacted by the cost of market goods and services and or labor that are going into our investments. Whether it's inflationary pressures on the cost of steel or the cost of wires or other things. Those are also putting upward pressure on our capital investment plans at the same time that our cost of funds is going up. When we think about where we head from here, right? I mean, a lot of questions I get from my stakeholders are, well, the market's really hot, right? I mean, can you just slow down your pace of investment? A couple things to think about, right? Commissioner Drexler talked about it. The move to sustainable generation. We set certainly in the Midwest with a fair amount of fossil fuels still in our generation portfolio. We face a significant amount of pressure from EPA and federal regulations that are putting more pressure on the continued use of our fossil fuel generation. We also face pressure from investors. There's a group of investors that continues to grow that aren't interested in investing their funds if you have too high a percentage of fossil fuel generation in your fleet. We face insurance pressures. It's harder to find insurance companies that are willing to insure us at reasonable insurance cost for the same reasons if we have too high of a percentage of our generation that's based in fossil fuels. And then lastly, in that space, we face pressure from customers. We have a number of customers that are interested in sustainable generation and less fossil fuels, and many that have corporate mandates now that are seeking to move to 100% carbon-free generation. All of those things put pressure on our ability to slow down that transition. The second one to talk about is resiliency, reliability, grid modernization. We all have, and certainly Evergy does, we have a significant amount of our infrastructure that is aging. I mean, aging to the point where it is at or beyond its projected economic life. When you have that circumstance, we need to continue to change out and upgrade that infrastructure, mostly on the wire side. There's two real benefits for that. One, obviously, when you do that, you can add automation, you can add additional controls that will ultimately bring efficiency into your operation of the system and help move down some of your ongoing operating costs. It also tends to take pressure off of maintenance capital expenditures that have to be done if you have a failure of the system, or maintenance operating cost for the same reasons. So slowing down creates another cost pressure for customers if you're not, appropriately changing out aging infrastructure. And then the last one that we're talking about a lot in the industry, right, is electrification. And it's a broader term than just EVs, but we can focus on EVs, right? And if you look at the hundreds of billions of dollars that the automotive OEMs are putting into, providing, additional models of electric vehicles, you, you start to see pressures on the system to support that additional electricity need, both from a supply and from a wire standpoint. And if we fall behind in those efforts to support our customers for electrification, you can roll right back into higher affordability costs for an extreme build out, or maybe more importantly, higher reliability concerns if we're not keeping the system up for the add of electrification load. So, all of those things are considerations. Last thing I'd say, I agree with Commissioner Drexler. The Infrastructure Act and many of the funds out there are going to be an important tool in the process. Many of us are still waiting for the rules of the road and the details from the federal government on how some of those funds will be accessed and made available. For sure, the one thing we do know on renewable supply is there is a significant amount of tax benefit out there to utilize as we bring in renewables. Currently, it appears to be offset, or maybe more than offset, by the typical supply and demand pressures for the equipment itself and the supply chain concerns that everybody's seeing on installing new wind or solar, and those build costs are kind of outpacing right now the benefits of the tax savings. And we're going to need to hopefully get to a little bit more normalized supply chain on there, so we can make those tax benefits accrue to the benefits of customers, and not just be a partial offset to higher inflationary cost of the resources themselves. So I think I'll pause there for now, but that's kind of the average view of the lay of the land for some of the pressures right now.
Thanks, Darren. Steve?
Thanks, Michael. And yeah, thanks to all my colleagues. Interesting comments. The thing I do is when I'm talking about forecasts is I always try to step back and step away from the narrative and look at the data first. So I'm going to add a little data to what Carly talked about. She talked about a 500 basis point increase in the federal funds rate over the last year and a half or so. So what has happened to utility stocks over that period? They're actually up. That tells us something. It's not a complete thought, but no one in the utility sector is freaking out. Investors aren't freaking out. That's an important point. And why is that? Well, utility stocks are usually like long-term bond substitutes. So if when we do the cost of capital, the shortest sort of rate we would ever use as a risk-free rate is a 10-year, usually 10, 20, or 30. And if we look at the inflation rate embedded in those rates with the TIPS securities, I did just calculated the 10-year, it's 2.4%. So now I'm starting to put some data together with a narrative that said Carly's analysis is interesting, but if I'm a utility investor, even if I don't hold for that period, the valuation, it's not really affecting my valuations very much. And in fact, like other people, like Kroll, which is the old new name for Duff and Phelps, actually has just lowered the equity risk premium, saying stocks are getting less risky. The VIX measure of volatility is at a very low level. The markets are much more certain. So I'm trying to take what Carly's saying in the monetary policy range and walk over into long-term investing. And I don't see much action here. And here's another interesting thing about attracting capital. This, I think, is, I'm working on a paper with Jan Beecher at Michigan State Institute of Public Utilities and my attorney, Kara Coburn-Ferris. Which of these stocks is more attractive to investors? Wisconsin WEC Energy Group, which has at the holding company level an 11.5% return on equity, or Black Hills Corp that has an 8.5% return on equity. Turns out Black Hills is the better investment. How is that possible? Because Black Hills sells at 1.3 times book value, and Wisconsin Energy sells at 2.5 times book value. Investors aren't going to just look at the ROEs. That's one of the drivers. But we know that utilities have always been able to issue capital at just about any ROE. And I had the advantage in my 43 years of starting. When I started in regulation, I didn't realize how unusual it was, but in the first case I did, the 10-year Treasury bond note yield was 14.2, and the ROE was 14. So now think about that. That's not the cost of equity, that's the Treasury bond. So the cost of equity was probably 19, something like that, and they got 14, and the utility stocks traded at 70 cents on the dollar. That's actually what attracts capital, that last part, because the last thing you would want to do if you had any control over it is build big plants, and the utilities were building coal and nuclear plants. They had no trouble raising capital. Why? Because the stock price dropped down to the level where capital access is. So I'm not saying that's a good situation. There's a big problem there, but it's not capital access. Wall Street will gladly find capital for you at just about any ROE, but who bears that consequence? The people already own the stock. That's where the fairness issue. So there's a big fairness issue, but there's not a capital attraction issue. There's essentially the utility has gone through its entire history. And even then that was a 8-year period where utilities sold below book value. They raised more money then than they do today if you adjust for inflation. So we got to get that part out of the discussion and talk about, well, we just need the Hope decision and the FPC versus natural gas pipes. So you got to be fair. So what happened in the utility industry from 1965 to 1980, while that process that I'm describing to you to allow you to raise capital went on, and utilities built all sorts of facilities, the existing investors lost 75% of their market value. That's the investor group that gets hurt. Not new investors will not buy if you don't give them an attractive ROE. And people are going to buy Black Hills today before they'll buy WEC Energy Group. Why? Because the pricing is more attractive. So that's a part that we have to be careful about. It's too easy to let the narrative lead you when in fact the evidence and the models show you that capital attraction is not an issue. So I think what Carly's talking about is pretty interesting, but here's one more thing. Watch how the narrative can mislead us. Hey, all these things are going to be coming due. These long debts are going to be coming due the longer if we go higher for longer. Except that utilities issue, the shortest bonds they issue is 30 years. So the bonds that are going to come due in 1993. This is actually going to be lowering interest rates for utilities because the interest rates in 1993 are much higher than they are even today. So when we try to apply the narrative to the data, we should let the data speak loudly. Now, I'm not saying that everything's easy, but if we use the long history of utility regulation, what's going to happen if inflation really does keep percolating up? In the short run, that's going to hurt consumers, actually. But in the long run, investors are going to get hurt because what happens is regulators, they don't do one-for-one adjustments on inflation and interest rates. When interest rates go down, the ROEs don't come down and when interest rates go up, they don't go up one-for-one. So this certainly has implications, but the fact that utility stocks have almost changed not at all tells us that there's no investor concern right now about all of this stuff working its way in. That could change, but I know that investors are smarter than all of us. We're not going to see this before the The bond market, the global bond market is a $126 trillion market. People know what they're doing in terms of buying and selling. So what my message here is, let's be careful to try to sift through this stuff. I think Carly is setting up for utility investors. It's sort of on the fringe for us, for investors. Now, for consumers, inflation hits, as Commissioner Drexler talked about that, inflation hits immediately. So consumers are going to bear the short run consequences. And then whether investors bear any or major will depend on how it plays out. But as you can tell, the one thing I'm not worried about is attracting capital. I am worried about existing investors taking hits, because that's a fairness issue. But I want my message, overarching message is, let's look at the markets, let's look at data, let's look at behavior, and take the messaging, the narrative messaging, and see if it fits. And it might fit, say, in the consumer products industry, but maybe not in the utility industry. So we need to be very careful not to sort of fall for and I'm not saying Carly's presentation was very good, as I said to her before, because she did a sort of a multi-scenario. That's fantastic. That's what you want to do. But right now, I just have that in my hands, and I'm going to look at it. I'm not going to make any major shifts in how I approach cases or anything like that, because I think it's a little early. My only concern, though, is again, with Commissioner Drexler, I'm worried more about consumers than inflation. I'm a consumer advocate, and I'm worried about, as those input prices, not so much cost of capital, but those input prices for fuel and labor go up, those just get passed through. So that could cause some problems. And then the capacity additions, as Darren was saying, you're modernizing the grid. Those are going to drive costs for customers. So right now, I'm actually more worried about ability to pay than I am about ability to build. I don't think there's a problem with ability to build. So I'll stop there.
Thank you. We do have a couple of questions in Q&A. I want to touch on one thing, though, to follow up on this input cost part that, as Darren brought up, because we have focused a lot on the cost of capital, but we also see inflation on the input costs, especially on wages. And just yesterday, the day before, I saw a report about how state and local governments are now starting to actually increase wages to start filling jobs at those levels. And that puts pressure on wage markets more generally. Dr. Stedman, how is that going to perpetuate this higher, longer, even more, or is that already kind of built into the scheme?
Well, as I showed in my slides, we've been following developments in wages for some time, and we follow a number of measures of labor market tightness, so to speak. In terms of looking at specific industries, we've been very focused on, of late, the service sectors, right? Because these are very labor intensive, and they feed on both the supply and demand side in services like shelter, and they're very important on the demand side in housing in particular. So when I think about an industry or particular industries that I'm watching when I am contemplating changes in wages and their implications for this particular bout of inflation, I think about wages in service-oriented sectors, because that's a particular inflation that we're focused on at the moment, because that's where the rest of the progress lay. So to sort of circle back and give sort of a two-part answer, we've been watching wages for a long time in this particular bout, but as inflation has shifted or rotated rather from goods to services, we've been sort of shifting our attention more to those wages that feed more into services inflation, while still keeping an eye on the aggregate number. But like I said, that's just one of many things that we follow.
So with respect to measuring the energy inflation, the part that you referred to, how much of that do you know is gasoline transportation type energy services? You mentioned the price of oil. And how much is it the utility, electricity, gas service? How much of, kind of in terms of the energy, how much of our energy inflationary pressure issues are in the petroleum market per se versus the utilities markets? Mm-hmm. Do you know, or do you even know? You may not know off the top of your head.
It is knowable. I do not know off the top of my head.
There you go. So we'll look that up. Ted, I'll try and look that up and circle back with you offline on that. Another question from Chuck Eunice, the Consumer Advocate's Office at North Carolina, I happen to know. Do the current economic conditions suggest a need for utilities to shift capital structures to a higher percentage of debt during periods of low-cost debt? Is there a need supported by supply and demand principles for higher cost of equity in the current economy? So should the capital structures of firms be adapted in response to the interest rate environments? Commissioner, I'll let you start with that, and then maybe Darren and Steve. Oh, you're muted.
Yeah, I mean, it's a good question. I mean, you can't, it would take an enormous amount, I think, of preparation and understanding and seeing the future. And, you know, Fed's not going to tip its hand. You don't necessarily know what the economic conditions are about to be. So to plan ahead like that, I think would be very difficult. I think it would, it's an interesting question, and with a crystal ball, you could maybe plan for that, but I don't know whether doing something like that would even be feasible.
Yeah, it's one thing when we know interest rates are close to zero, they can't do anything but go up, right? But now that we've gotten above zero, there's that possibility of going up or down. It does make it a lot more difficult. Darren, what would be your take on that? Or
yeah, thanks. You know, I mean, I'd probably echo Commissioner Drexler's comments. I mean, you know, Steve mentioned it, but you know, oftentimes when we're financing activities, we're financing you know, long-term capital intensive business, right? And we might not do all 30-year bonds as Steve talked about, but we certainly have you know, a fair share of those, as well as mixing in some shorter tenor bonds. And I think, you know, probably hard to play the market. It's a little bit speculative in nature, and generally, you know, our regulators and our stakeholders aren't huge fans of market speculation on our part. They'd like us to be predictable and have a plan and kind of execute pretty consistently, which in this case, you know, would put us securing investment that's supportive of or funds that's supportive of the tenor investment we're making.
So, Michael, can I jump in on that?
absolutely.
So I think this capital structure issue, talk about going from narrative to numbers. I think it's one of the most complicated things. I'm going to tell you something that's absolutely true, and it's going to sound like illogical and irrational, but let's say you take on more debt, and so your bond rating goes down. So your cost of debt goes up, and your cost of equity goes up, and your cost of capital goes down. Now, how is that possible when anything you're financing with is now more expensive? Because the cost of capital is a 5-variable equation. Cost of debt, cost of equity, amount of debt, amount of equity, and taxes. And so it's very common that a firm will move from a single A rating down to a triple B, and both its cost of debt and its cost of equity go up, but its cost of capital goes down. Now you can, back to Commissioner Drexler, you actually have to run the numbers. You can't just say that but it's not a slam dunk that a lower, worse bond rating is bad for consumers. It actually often can be better. And we don't hear that part. You have to actually, we did some analysis in a recent case in Wisconsin, and it's like, yeah, it looked like if the utility had a bond rating notch coupled down, their cost of debt and cost of equity would go up, but their cost of capital would go down. So that's that 5-variable problem instead of 2. And try to answer that question about now, where are they going in the future? I agree, that's really a tricky thing. But even if you knew what the interest rates were, you still might be surprised at what the answer is as to whether you should take on more or less debt and have a higher or lower. I'll tell you, the worst thing for consumers would be a AAA bond rating. I can be sure that that's terrible because it's way too expensive. The cost of debt and the cost of equity would be low, but the weighted average cost of capital will be very expensive. So that's the kind of framing we need to think about when we look at capital structure issues. And I think it's in the abstract, you cannot answer the question that the consumer advocate asked.
Very good. We are a little over time already, and I'm sure we could probably go on with more of with this conversation. There's certainly a lot of issues to delve into. Someone did ask if we would be able to distribute Dr. Stedman's slides. We are going to check on that and make sure that those are appropriate to share publicly or in an unconstrained form. And if so, we'll share those on our YouTube channel along with this video. This video, as well as all of our all of our HTH webinars, are available on our YouTube channel. It's at FRI-Mizzou, M-I-Z-Z-O-U. I want to thank our panelists today for joining us. I want to thank all of our attendees for joining us today. We do have a couple of other questions in the Q&A that I will try and get back to afterward, but in the interest of time, we will call it a day. Again, thank you all so much. The FRI is, our goal is to help make more informed regulatory policy for utilities across the country. And this is certainly one of those conversations that's important in that process. So Dr. Stedman, Commissioner Drexler, Darren, Stephen, thank you so much for your time. And we will see you on our next HTI, which should be later this fall. Thank you and have a good afternoon.
Thanks, Michael.
Thanks for having me.
Thank you, Michael.
Thank you, Michael.